Welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Thursday, March 2nd, and let's get right to the three topics that we're paying attention to as the markets are moving as a result and what we should be, or how we should be positioning accordingly. So let's get right to it, and thanks for watching. Basically, a more aggressive Fed. Again, there's more talk now that there's going to be a 50 basis point rate increase or increase in interest rates in the month of later this month of March. Basically, 2 weeks ago, there was a 0% chance of a 50 basis point increase. It was more expected of a 25 basis point increase, but if you saw last Friday's inflationary data, the number one thing that the core sort of CPI number that the Federal Reserve looks at came in hotter or higher than expected, showing that inflation is still here and very much part of the society, entrenched in everything that we're seeing right now. Obviously, we're going to talk about the 2-year Treasury hit 5%, so well over 5% right now. It's a great place to sort of position an asset allocation, some of our cash, put it to work. You get paid while you wait. And then the 30-year mortgage today is back above 7%. In October, it hit 7.3%. We're going back above 7%, and we'll talk about that. But right now, you got the S&P 500. This is basically a technical chart, and basically the calendar looking at the last year of the S&P 500. Obviously, we're seeing the downtrend, but you see the purple line and the green line. And what's important right now is where the blues or the daily, essentially, if I can get this a little bit larger for you, it's essentially just the daily price movement from open to close of each calendar day that the market's open. And so you saw that, obviously, the month of February, we had the markets now putting pressure on the downside because interest rates are rising, because inflation's rising. We're still stubbornly high. That's causing the Federal Reserve having to be more aggressive. When interest rates rise, basically equity markets are getting spooked that there's going to be additional sort of more aggressive Fed. And what we're seeing here is the green line right here is what we call the 200-day moving average, and that is right now at 39.39. So today we should see the S&P right now is vacillating back and forth under and below this number right here, but it's a key technical number, meaning if we hold this line and we close above it, that means that we could see the market now sort of trend higher for the balance of March. If we close below it and then sort of subsequent trading days continue to sort of test that 39.40 level, if you will, and stay underneath it, that means that lower lows are ahead. So we got to keep a technical eye on the S&P as an indication of what's to come from a trend perspective. This is a chart that basically saw 2022 as the most Fed hikes on calendar history. This was last year, and obviously, basically this time last year, the Fed started raising rates from ultimately 0 to well over 4%. Now we're in the 4.5% zip code, and the market, by way of the 2-year Treasury, is saying 5, maybe 5.5 is ultimately where we land, and that's really putting the pressure. Now, the reality is, the last 3 years, the Federal Reserve has been behind the yield curve, or behind sort of what the bond market's telling us 3 times. And ultimately, that the concern would be, does the Fed really make a policy error and either do too little to not get enough ahead of inflation, or because they're behind, that's what the market's telling them. So they have to do sort of more hikes and potentially for longer. And historically speaking, Feds have tendencies to dip economies into a recession. So we're going to keep an eye on corporate earnings, margins. Hopefully they're being sort of protected, and there's a lot of purchasing and pricing power for corporations. Right now, we saw earnings season. Yes, we're actually seeing margins decline, earnings decline, but margins are still sort of hanging in there. So that means that there's still growth and a strong economy for corporations to ultimately make money. And we all know the issue. There's 2 job openings for every 1 person that's ultimately looking for employment. So there's the tension in the labor market, which is wage inflation, which the Fed really can't get a handle on. They're trying to slow down, so companies slow down hiring, hopefully, potentially, what their thought is, layoffs, adding more opportunity to close that wage gap or that labor gap that we're seeing. This is a chart right now of basically the US dollar, and ultimately what I want to show you is it's the inverse effect. So, you're seeing that the dollar came down over the last few months. But ultimately, as the interest rates now rise again, they're supporting by strong interest rate policy or more interest rates going up. The dollar has turned the corner and ultimately is back to an uptrend. So we'll see how far the dollar uptrend continues. And finally, let's talk about mortgage rates again. Again, they touched 7%. Now, historically speaking, if you look at the last 40 years, the average mortgage, okay, this is from Mortgage Association of Realtors, the average basically mortgage rate over the course of the last 40 years was 7%. We just crossed 7.1% today. It was 7.3% again back in October. So we're again on back over the 7% mark. Now, what does that mean? Well, that means that mortgage interest rates jumped 100 basis points in just the last 30 days. Well, what does that mean for kitchen table economics, Rob? Why should it matter? Why should I pay attention? Well, look at this. This is from CNBC. The monthly mortgage payment on a $400,000 home with 20% down in today's rates at 7% versus what it was around 6% less than 30 days ago. It's an increase of $230 per month. You know, that's well over $2,000 again on an annual basis. So the cost of just buying a home is gone up because of the mortgage rates. We saw when mortgage rates basically came back down from the 7 to 6 range, we did see a pickup again in real estate activity. And now that's sort of cooling off. So there's that give and the get. You're seeing sort of, you know, the consumer being very price sensitive and cautious. And that's sort of what we're going to see, I believe, play out not only in the real estate market this year, but also in corporate America. Again, we keep an eye on earnings and margins and to see if the consumer is going to sort of be data dependent, depending upon where mortgage rates are. And the Federal Reserve is going to be lagging effect. And they're going to be data dependent in the rear view mirror. So those two have to coincide at some point in time and get on the same page later on this year, hopefully. And then we can see sort of the S&P sort of take off from there. So in the meantime, that's our update for today. Thanks for watching, and like and subscribe, and be sure to share and with a friend or family, if you will. Take care and have a great day.